Good morning. My name is Ilene Slatko, and on behalf of myCPE, I'm going to talk to you a little bit about the 75 basis point rise we saw in Fed funds rate earlier this week, and then how that may impact your business and certainly your clients' portfolios. I am president of DSS Consulting. I help people learn more about financial education, and I drill down specifically on helping to understand how we approach it and make good financial decisions. So this is a great opportunity to chat with you today, and I want to pull back a little bit and chat with you from an historical basis, because my guess is that many of you have not seen this level of inflation before and aren't quite sure how best to work with your clients and what to do. So I believe that it's very important to help your clients to see two things, or to do two things. One is to help them see the historical moves in the market, the historical nature of the stock market, which, as you know, tends to have peaks and valleys, but to continue to march on an upward slope on a long-term view. So we have to get past looking at the daily or weekly or even monthly gyrations at this point. And the other thing I want to encourage you to do is to swing more towards education right now and helping people to have discipline in their financial decision making. So I know a lot of them depend on you, and when we as advisors, and I say we, I used to be an advisor, I no longer am in the business of working with clients on portfolios, but when we as advisors aren't certain ourselves, it shows in how we talk to clients. So let's think about how best to approach our clients. First of all, I pulled up, just for fun this morning when I woke up, I pulled up April 1987 to see what the market was doing then, because that's when I actually started in the business. And the first headline that came up on the search was Dow plunges 51 points. Now, we can laugh about that now, because now a 51 point drop is barely moving the needle. We certainly wouldn't say that it plunged, but back then the market, the Dow Jones, had not yet hit 2,000. In fact, on October 19th, 1987, Black Monday, the Dow dropped over 22%, and it was still just 508 points that had dropped. So from a historical standpoint, the market has grown tremendously since then. We made it past that huge drop, which was also triggered by a rise in interest rates. Unlike now, however, we did not have a Fed back then that was telegraphing the rate increases as a way to slow down inflation. Rates were going up, but it was a very different environment. And so one of the things that caused the huge drop was that we sort of hit that tipping point. The benefit now is that we've got a roadmap. The Fed has said we anticipate raising interest rates through the end of this year and into 2023. We anticipate the rates being at X amount by the time we're through, and we're going to see the level of consumer spending and the health of the economy in between, so that as we make our decisions, we'll base it on how the previous rate decision has impacted the economy and whether it's slowed it down enough to cool off inflation. So your job becomes helping people understand from a historical standpoint what's happened in the past, what's likely to happen, and to encourage them to learn how to decouple their emotion from making their financial decisions, which is why they have you. Remind clients that for every rate increase, if they are looking for fixed income, then they get the benefit of that. I should say that the first rule here is that my first rule would be clients should be moving into a little bit heavier cash positions to take advantage of what's happening in the market. Clients should be moving from more risky stock positions to higher quality positions. Quality is probably going to be more stable. Will it give them the pop? No, but at this point in time, many clients are going to want to just have stability and not have to worry about it. So, but it's your job to then help them to see the history and the roadmap that we have and how that's likely to impact them. So of course, we know that there's a difference between the Fed funds rate and the discount rate, and then how that trickles down to both the interest rate that clients pay and the interest rate that they get when you're looking at fixed income. Help clients to understand that the yield, the interest rate that they get, and the price are going to be in direct opposition. So help them to understand if they don't already. Take a breath. I don't think that we're going to have any huge drops. But again, I may be wrong. I'm not a prognosticator, but I think that the way you can position clients right now is to expect the worst, hope for the best, but expect the worst. So that's how we have to plan. I look at what my father used to say all the time to me, and that was, when you are unemployed, the unemployment rate is 100%. When you're working, the unemployment rate is 0. So right now we've got people who are in cash, who can take advantage of the drops in the market, who can buy into the higher yields. So those people are going to be less concerned about the short term. And so your job is to help move many clients, as many as you can, and who are willing to, into a position where they can take advantage. I always say the stock market is the only place that I know of where, when they're having a sale, i.e. the market goes down, when they're having a sale, everyone says, oh no, I don't want to buy right now. I'll wait until it goes back up to 100% of value, or maybe 110%, just to make sure it's on the right path. The other thing to show your clients, again, in helping them to get a discipline, I often talk about with clients about how to have a discipline to sell, having those stop losses or the trailing stops to protect a position either from additional losses or to protect a gain that we have. Now we have to change that and talk to people about stepping into the market. One of the things that is that, one of the things that is it's very easy to sit on the sidelines and say, I'll wait. What if it goes down a little bit more? I'm afraid that it'll go down more. It went down yesterday. I'll wait until it's on the way back up. The thing to show your clients and help them understand, and you can see this if you show them a chart, whether it's 5 years, 10 years, 100 years, it doesn't matter. Ask them to pinpoint exactly when on that chart they would have known that the market was going up. And the only way to know with any certainty is after it's already happened. So you're in the position now of helping your clients to establish a discipline to get back into the market. So raising a little more cash, moving from lower quality to higher quality, being prepared for what's coming and being able to make decisions that aren't emotionally based, on how to step back into the market, because ultimately that's where the growth is going to happen. I'll end by talking about how for those of us who live in places where we have a winter, we know that we're a winter where it might snow. We know that it's going to snow, or that there's a possibility it's going to snow, and so we prepare for that. We make sure we have a good snow shovel. If the one last year broke, we go get a new snow shovel in October, early November, before the snow comes. We make sure we have sand or salt or whatever we use to spread on walkways so we don't slip on the ice. We make sure we have that handy. The Fed has given us a roadmap. We know interest rates are going to continue to go up based on how the economy responds. So your clients can take advantage of those rising interest rates by having a discipline to step into the market. And your highest job right now is to help people understand that whatever the gyrations we see right now will probably not, if we look from an historical standpoint, will probably not continue. And it's just a question of riding through where we are right now. Thank you. This has been, I'm Ilene Slatko. It's nice to chat with you. Bye.